Hey everyone, welcome back to Advanced Accounting. In the past several classes, we talked about intra-entity asset transfer. Specifically, in last class, we talked about intra-entity net transfer and intra-entity depreciable asset transfer. Let's do a brief review here first. For intra-entity net transfer, we have two consolidation entries. So basically, in the year of transfer, we have consolidation entry TL. And in all of the subsequent years, we have consolidation entry star GL. Star GL entry, we have two versions of the star GL entry. The first version is in all of the following years until before the year of sale of the land to outside party, we have the star GL entry version 1. And in the year when the buyer of the land sold the land eventually to some outside party, we have star GL entry, the second version, version 2. So let's look specifically at what TL entry is. TL entry we recorded in the year of transfer. And the basic purpose of the TL entry is to, when there's a land transfer, so there can be two situations. Either the seller of the land is selling the land to another party within the same consolidated entity for a higher price. So the seller may recognize a gain from selling the land within the consolidated entity. So for example, the parent and the subsidiary, the parent may sell the land to the subsidiary at a gain, or it can sell the land to the subsidiary at a loss. And the consolidation entry we're talking about here, this is just for the situation if the parent is selling the land at a gain. So basically using this consolidation entry, we eliminate the unnecessary gain because this gain is you are selling to yourself, which shouldn't be recognized once the two firms are combined. So that we need to eliminate it by debit gain on sale of land. And then also when you are selling the land, if it is sold at a gain, the land value is kind of appreciated, right? So maybe the original value on the parent book of the land is $50. And then the parent may sell it at a gain at 60 to the subsidiary. So now the land on subsidiary's book becomes 60. So it is by doing this transaction, the value of the land is appreciated. So using this consolidation entry, we eliminate the appreciated value in the land. So this is the situation if there is a gain on sale of the land. And we haven't talked about last class. There's a point we haven't mentioned in last class is if there's a loss in the sale of land, then we just do something like reverse to this general entry. We need to debit land and credit loss on sale of land. So the logic is the same here. Suppose the original value of the land is 60 and we're selling it to the subsidiary at $50. So the parent recognizes a loss. And then the net value is kind of depreciated, it kind of goes down by $10. And when we view two firms as one firm, it shouldn't happen. So we need to eliminate the loss we recognize. At the same time, we need to kind of restore the land to its original value, which is $60. So this is the first entry, TL entry. And for the entry star GL, the first version of the star GL entry, which we record up until before the year that we finally sold the land to the outside party. The star GL entry it is just a carryover of your TL entry to subsequent years. Sorry, that is star GL. So here we just carry over your previous TL entry, and the only thing we're doing here is we're replacing all of the income statement account by retained earning. Specifically, it is the retained earning of the seller. And if the parent is using the equity method, because in this situation, the parent has already kind of reversed this unnecessary gain or loss by a general entry it is doing on its book itself. So instead of debit retained earning, we debit investment account. So this is star GL entry, the first version. And the second version of the star GL entry is at the year of sale. this star GL entry is basically the previous star GL entry, the first version, plus a reversal of the TL entry. Because when you finally sold the NAND, we can reverse that part of the gain or loss can finally be realized. So we need to reverse the TL entry, which we record at the beginning. So this is about intra-entity NAND transfer. And regarding intra-entity depreciable asset transfer, we have basically 3 general consolidation entries. So in the year of transfer, we have TA entry and ED entry. And these 2 entries gets to be carried over to the next year. It becomes the star TA entry. And in the second year, we also need to record another ED entry. And these 2 entries gets to be carried over to the following year after the second year, the third year. So then we have a new star TA entry. And in the third year, we need to record another ED entry. And then this star TA entry and ED entry gets to be carried over to so this is first year, second year, third year, fourth year. And then we need to have another ED entry. So this just goes on like until this asset is like finish its depreciation. Specifically, the TA entry at the year of transfer, it is to debit gain on sale of equipment, debit equipment credit accumulative depreciation. So one thing we haven't mentioned here, the assumption here is the depreciable asset is intra-entity transferred at a gain. So that's why we need to eliminate the gain on sale of the equipment by debit gain on sale of equipment. If it is transferred at a loss, what should we do? So if it is transferred at a loss, we need to credit loss on sale of equipment, right? So this is just and also because when we transfer the equipment, we need to write off the original book value of the equipment. And then because this equipment has already been depreciated, so once it is on the subsidiary's book, usually the value the subsidiary is recording is less than the book value that is eliminated on the parent's book. Suppose this is a downstream transfer. So that's why we need to debit equipment and credit accumulative depreciation. But the situation can also change. Like if you are intra-entity transfer this equipment at a huge gain, which make the book value even appreciate. The new book value, the new face value of the equipment is even more than the original book value of the equipment. Then we may need to credit equipment. So it's all like a case by case situation. The thing is that you need to really understand it in order to write this journal entry right. So this is just example. This journal entry is just for the situation that intra-entity, the asset is transferred at a gain, and the equipment, the original book value of the equipment is more than the new book value of the equipment. So this is the journal entry we write in this situation, which is pretty common. But you should also understand there can be other situations that may need you to write this journal entry a little bit differently. And then the ED entry, so we have it in the year of transfer and all of the subsequent periods. The entry is to debit accumulative depreciation, credit depreciation expense. So this is just because the equipment, once it's transferred, the face value becomes less, and we're depreciating at a less face value, so that the depreciation expense, so we are recording it at a, so for example, the original book value of the equipment is 100, and the original accumulative depreciation is 60. So the book value, the net book value of the equipment is 40, and it is transferred at $60. So the originally the equipment can be depreciated, for example, for another 10 years. So if it is still stayed on the seller's book, every year the equipment is depreciated for $4. And then because it is sold it is sold at a gain. So now the equipment is depreciated at $6. And then so which means that we're recording more depreciation expense. And then so that's why we need to credit depreciation expense to credit back another $2, which is the depreciation expense, the more depreciation expense that is recorded, we need to credit back. So this is for the situation the equipment is sold at a gain. And if the equipment is sold at a loss, you can say that this journal entry needs to be reversed. So that is the ED entry. And we have start TA entry for subsequent period, which is basically we combine the previous TA entry and ED entry, and that becomes the start TA entry. Which is basically like we debit retained earning for the seller, and except if the parent is using the equity method, we debit investment account instead. So this is a review of what we covered in the previous class, which is intra-entity asset transfer, intra-entity net transfer, and intra-entity depreciable asset transfer. Now, let's begin today's class. We're going to talk about intra-entity debt transfer.